Hi, this is Paul from globaltradingsoftware.com, and this is a range breakout trading tutorial for the oil pit open. I'm going to go and use two indicators on this. I'm going to use the new xBrat range breakout indicator, and I'm going to use the manager to manage the trade. So first of all, this is where we are live right now. This was the range from yesterday's oil pit open. So I'm going to talk about how that would have been traded. I didn't trade it, I'm going to be honest. I've been sick, but I just wanted to get some of these training videos out to show people how to use this new indicator. So first of all, the oil pit open is not part of the default settings. So when we open the opening range and go to settings, there are four defaults: the gold for Europe, the London, the New York Gold, and the New York Stock Exchange. And then we've got two which are customs, custom 2 and custom 1. You can put whatever you want in there. You can change CL to oil there, for example, and it'll change it on the thing there. So the starting hour is at 9, okay? That's the exchange hour, so that's at 9 AM EST. I'm going to show the label, I'm going to show the lines. You can see how the label's changed to oil now, and click OK. So you know, whether you're using for oil or whether you're going to use it for a data event like NFP or something like that, there's lots of ways you can use this for different opening ranges, but I'm just going to concentrate on oil today. A lot of oil traders out there, and this is what we're going to be looking at. So first of all, we're going to use the 5-minute time frame for metals and energy, really, for this opening range breakout, because that is with the optimized time frame that we've looked at through our backtesting system, and basically through my experience, the 5-minute time frame is the best time frame for that opening range. So when the oil pit opens at 9 AM, which is actually 3 PM European time, we get that first candle form. While that candle's forming, this label will be turning yellow, red, green, whatever, because it's indicating what the bias is, so where the trade should be for you going out of this range once the candle closes. Also, this range, as we start to form this range, that will be coloured in green or red or amber for neutral, as this first candle is forming, and other candles are going all the time. So what happens then is when the candle closes, that's fixed, that label here, the oil label is fixed to green. So you're only looking for longs. That's it. You're not looking for shorts, you're looking for longs only, and you're looking for longs breaking out of this range. Now you can look at these pre-market highs if you wish, or the overnight highs if you want to be a little bit conservative, but in reality, if we get that oil pit open, which means there's increased volume now, there's more people trading oil futures, when we get that range, if the bias, if our software says you only look for the longs, when it breaks out to the long side, there's a good chance it's going to do that. Now we have a really nice move from there. We have probably just before the New York Stock Exchange open about 60 ticks. That's a good trade on oil, but managing this trade is a little bit more complicated, made simple by the manager. So oil pit opens half an hour before the New York Stock Exchange opens. So sometimes it's a good idea, you know, to take that 60 ticks profit and get out. Now you can see what happened here is that the price action came down to test the top of this range, of the opening range here, bounced back up and just kept going and going and going and going. Now the manager would help you understand that. So here we have a down candle, a red candle with higher than average volume. That's a warning sign that it's going to come down. We then have a rejection of the lows, a bullish candle with higher than average volume, so it's still not ready yet. Then we have higher than average volume move down on a red candle. The following candle has less volume. It's a down candle, but it's average. Then we have a rejection at this opening range, at the top of this opening range, on average volume. Then we start to move up again. All this time, the cloud, the bias cloud for the manager is green. It works off a different formula than the opening range bias, but the bias is green, so we're bullish. We do have a pullback here again, but it runs out of juice. The cloud just remains green. Then we get this massive move up with higher than average volume, lower than average volume pull back, because you see these little blue dots underneath these, so this pullback is lower than average volume, and then we pull up. We just keep going and going and going and going until such time as we get 2 consecutive higher than average volume down candles. That's a time to either get out aggressively, but to be honest, a few candles later the bias cloud turns to red at that point anyway. So 2 ways to look at this. Use the opening range to scalp those 50 or 60 ticks. Fantastic. Yeah, great trade. But you can also then include the manager. Try and get those longer term runs for the rest of the day. You know, sometimes it won't work. Sometimes you'll get that 50 tick scalp, it'll come back down, come back through the range, the bias for the range will turn red, and you'll probably trade short out of the bottom of the trade. But about 80% of the time, once that first range is set, and it's either set red or green, if it's set green and we go long and it moves up, it continues that basic bias for the for the remainder of the day. And this is what we had. So we had, in reality, if we'd have been sensible and used the manager to manage that range breakout trade, there was approximately just over 200 ticks, $2,000 per one contract on oil there. So again, it's a great strategy this for scalpers that want that opening range on oil. And you can trade indexes with it, you can trade Forex, gold, platinum, you name it, natural gas. But this is just an oil example where you get the bias. He's saying only be interested in the longs when it breaks that first 5 minute range, and then using the manager to actually then manage that trade sensibly, to understand that that behavior really helps to maximize those profits. So even if you'd have taken 60 ticks on that first initial scalp, seeing that it actually came back down and tested the top of that range, once it starts to move away again, you really should be looking to get it back in that long, and then using the manager to keep you in that long. So there's a few different ways there, but it all starts with that opening range. And our new xBrat range breakout indicator not only defines that range for you and allows you to look for ranges of data points around the 24-hour period, whether you're a European trader and you've got big Europe data coming out and you're trading the DAX, all of that is adjustable. But once that definition is there, you need to understand the bias. Where is the bias? Is it neutral? Is it bullish? Is it bearish? It actually helps you make that decision on where you want that breakout to go, as long as where your trading is. So if it's green, you're only interested in the longs. If it's red, you're only interested in the shorts. If it's amber, you could put a straddle on, either long or short, or just walk away because you see indecision in the bias for oil on that particular day. So hopefully this training video helps for the new xBrat range breakout trading indicator, but also then using the manager to help manage the trade and maximize the profits.